Section 9-2 talks about accounting for merchandise purchases. So remember in Chapter 9, we started talking about how we're a merchandising business rather than a service business. So part of being a merchandising business or selling goods is we are going to have inventory, and then we're also going to make a lot of purchases on account, meaning we're going to purchase items and we only have to pay every 30 days maybe. So we are going to talk about inventory and using a new journal called the Purchases Journal. So inventory, that is the list of assets that you have, and usually it includes the value of the item. So you know the value of your assets. That is your inventory. Now, a merchandise company, they would have a merchandise inventory. This is the inventory of the specific merchandise that you're planning to sell. So the difference between inventory and merchandise inventory would be the list of all assets. That would include the things you're going to sell, as well as like the hangers and the racks and anything of value. Merchandise inventory is specific to the goods that you will sell. A perpetual inventory is something now that we have with computers and with checkouts with scanners. We know exactly how much product is brought on the truck and added to our shelves. They scan it in so they know what's added. And then when you check out at the register, it's scanned again to know what has been sold. So at any given time, you could look up exactly how much you should have of each product. Now, of course, there's some things that would make that change, and we'll talk about those next. So a periodic inventory, that is when you don't have a perpetual inventory system that continually checks it. Instead, maybe every month or every 3 months, you physically count the items. So periodic means you periodically update your inventory, count how much you have, and that's how you know. You have to do that by doing a physical inventory. That means you are going through and physically counting every item on the shelf, maybe weighing things or measuring things that you might have. So even though we have perpetual inventories that are current grocery stores, and at any given time, Hy-Vee or Fairway could look up exactly how much they should have an item, they still do a physical inventory as a double check, because the perpetual inventory only accounts for things that are scanned in and things that are scanned out. So that wouldn't take into consideration things that are stolen, product that is damaged and can't be sold. So even if you have a perpetual inventory system like modern day we do, it's still very possible that you might do a physical inventory to just double check those amounts. The cost of the items that you are planning to sell is called the cost of merchandise. If a pair of shoes is selling for $100 at Scheels, Scheels might have only paid $50 or $60 for those shoes. That is their cost of merchandise. Now, in order for someone at Scheels to make a purchase, so let's say the manager of the shoe department, they are wanting to order more shoes from Nike, they would probably need to put in a requisition. Think of a requisition as like permission to purchase something. So they might need to put in a requisition to the manager of the entire Scheels store to see if they can order that many Nike shoes. Once the requisition is approved, it is approved by getting a purchase order. So once the manager approves that requisition, they'll give a purchase order to the shoe manager, allowing them to make the purchase. So once they get that purchase order, they can put in that order with whoever they are buying the shoes from. In this example, you could see that our company, 3 Green Products, is purchasing from Win Lighting. So they've been approved. This is how much they want of everything and how much it will cost. Once they put in that order, and it looks like they're ordering lamps in this example, once they put in that order for the lamps, then once they receive it, they will use something called a purchase invoice that we'll talk about later. So I said earlier that we would have special journals in this chapter. And the first special journal that we're going to talk about is the Purchases Journal. So this is when we purchase merchandise on account. There's other journals. You can see here the Cash Payments Journal, the Sales Journal, the Cash Receipts Journal, and then our general journal that we've always used. But in this chapter, we're going to specifically use the Purchases Journal. So anytime you purchase on account, that means we bought something and we'll pay for it later. That's called purchasing on account. We will now use our Purchases Journal. which is a special journal to only record purchases of merchandise on account. And you'll see on the next slide that the journal looks different from our general journal because it has a special amount column. Just like in our general journal, we have the sales column and the cash column. There's a special amount column in our new journal. So here's our purchases journal. Notice that we have one account or one column, and it is a special amount column. The numbers debit purchases, and they also credit accounts payable, all in one column. So like I said earlier, once you get that purchase order approved, you will get a purchase invoice when you get your product or your merchandise. That purchase invoice is our source document for all of our transactions in the purchases journal. On that purchase invoice, it will also detail the terms of sale, which is the agreement between who we are buying the merchandise from, and it will have things such as how many days we have to pay, maybe if we are late paying, what the interest we have to pay would be, and then it would also have the due date, when we have to pay that money by. Here's an example of an invoice. You could see that once the invoice is received, it's recorded, and it would have someone's initials, whoever records the invoices as they're received, the date it's received, and then the purchase invoice number, which is the number that we will use. So you could see here they double check that how much they thought they should spend is how much they were actually charged, and they double check that they received everything they ordered as well. So it looks like our due date is the 4th of December, and that is 30 days from when we received it. So 30 days would be the terms of sale. So now we are going to record a purchase in our purchases journal. So on November 6th, we purchased merchandise on account from Win Lighting, $1,082.50, purchase invoice number 525. So once we receive those lamps from Win Lighting, we need to do our journal entry. Purchases, just like any other asset, purchases are an asset. They have value to our company, so they increase with a debit. Accounts payable increases with a credit. So just like we always have done, we start with the date. We are going to be crediting Win Lighting's account to show that we owe them more. We have purchase number 525. Notice that we don't have to put a P in front of that because right in our journal, it's labeled purchase number. So we know that purchase number is 525. Then we have our amount, $1,082.50, and that is going to both purchases debit and accounts payable credit. So that is how we record a entry into our purchases journal.